Happy Monday, everybody. I hope you put away your news and your email over the weekend and enjoyed. Today is going to be short, but I'm going to share with you some important updates as to what I'm thinking. These, of course, are just my opinions. So we're going to recap last week as we always do, but just a bit, and then you'll understand why. And then we'll preview this coming week in the news, and that will be quick too, and you'll understand why. I'm glad you're watching this. Please take a few minutes to watch this and be in touch if you want to talk about it. Today is April 7th, 2025, and this, of course, is your Monday market update. Let's just get it out there. We are where I've been telling you we would be at some point. Even just in the past few months, we've been talking about a correction and even a bear market, and the fact that they happen all the time and they happen often and they feel horrible. We'll talk in a moment about the thoughts on what to do at this time. We just wrapped up one of the most volatile stretches of the year, and it wasn't driven by earnings, a war, or the Fed. Instead, markets were thrown into a turmoil by the return of large-scale tariffs introduced midweek with minimal clarity and major consequences. Let's break it down. Markets came out of the gate Monday with a hard sell-off, rattled by renewed fears of a broad 20% tariff being reinstated on all U.S. trade partners. Later on, some saber rattling from President Trump toward both Russia and Iran, and stocks opened deep in the red. But then came the bounce. Treasury yields eased, the headlines calmed, and good old-fashioned month and quarter-end positioning kicked in. A steady bid took the S&P from a loss of over 1.5% to a positive close. Not something we typically see without help from the Fed or earnings, but it happened. Gold surged over 31.50 on safe haven flows, and oil spiked nearly 3% on sanction fears. The Dow was up 1%, S&P up 0.5%, the Nasdaq was up less than 0.25%. Tuesday was another grind, but this one carried a little bit more ominous tone. The ISM manufacturing PMI came in at 49.0, slipping back into contraction. Even worse, the prices paid component jumped to the highest level since June, reigniting concerns that inflation remains sticky, just as growth may be softening. We also got word that President Trump's Make America Wealthy Again speech was set for Wednesday afternoon, further fueling positioning around potential trade volatility. Still, the market managed to close slightly higher, powered mostly by dips in the defensive sector and a weaker dollar. The Dow was down slightly, S&P up 1/3%, and the Nasdaq up just slightly. Wednesday saw one more push higher as markets continued to unwind from oversold levels. Early in the week, a strong ADP jobs print did help sentiment early, and even a headline about China restricting outbound investments into the U.S. wasn't enough to derail the rally. That is until the close, or after the close. Just after the bell, President Trump announced a new baseline tariffs, 10% on virtually all imports, plus steeper levies on specific trade partners, 34% on China, 20% on the EU. The reaction of the futures market was swift, and it was brutal. You've heard about it by now, of course. S&P 500 dropped more than 3% in after-hours trading, and safe havens bid again. Gold and treasuries both rallied sharply while the dollar tanked. The Dow was up 0.5% for the day, S&P up 2/3%, and the Nasdaq was up almost 1%. That's just going into Wednesday's close. Just to keep the stage set, Thursday was the worst day since the pandemic. Markets didn't just sell off Thursday, they cratered. Sorry, I think I told you, I'm not going to sugarcoat it. The S&P 500 suffered its worst single-day drop since 2020. From the opening bell, stocks gapped lower as investors digested the new tariff regime and its implications. The economic data didn't help. ISM services missed badly, and the prices paid components remained hot. A recipe for stagflation. This was reported, but again, I don't think it was even viewed as a bump in the road. Defensive names like utilities and healthcare, they held up best, but tech and consumer discretionary were hit the hardest. Commentary from Fed officials grew more cautious. Foreign retaliation threats started trickling in by mid-morning. Even gold, typically a beneficiary of chaos, gave back some gains, a sign that liquidity stress may have started to creep in. By the end of the day, the Dow was down just under 4% on the day, S&P down almost 5%, the Nasdaq was down 5.25%. Friday delivered a gut punch to investors, capping off an already difficult week with the worst single-day market losses since the early pandemic-era crash in March 2020. The market opened deep in the red and never recovered. The catalyst? Retaliation. China fired back hard on Friday morning, announcing a 34% blanket tariff on all U.S. goods, effective April 10. That response came less than 48 hours after President Trump's sweeping tariff declaration, and it erased any hopes for quick de-escalation. The news hit before the bell and sent futures sharply lower. Stocks never found their footing. Adding fuel to the fire was the ISM Services Index, which came in very weak, just barely above contraction. Worse, the prices paid components held above 60, underscoring the fear that we're sliding towards stagflation, slower growth with persistent inflation. Like Thursday, I maintain that this was completely ignored. Makes a good news blurb, but the markets hardly noticed. The hope was that the jobs report would make a difference. Not Friday. The March jobs report actually beat expectations at 228,000 jobs added and wage growth at 4.1% year over year. In any any other week, that might have helped. But in this environment, it was brushed aside. Investors no longer just focus on growth. They're worried about policy risk and geopolitical fallout. And this kind of data is seen as backward looking. As if you needed to know, the CBOE, the volatility index, the VIX, it surged to its highest level since 2020, crossing 40 intraday, a sign of panic and severe risk repricing. Safe haven flows into treasuries pushed the 10-year yield down to 3.89%, a sharp move from over 4.2% earlier in the week. Dollar dropped for the fifth straight day. Gold, while off its highs, did hold firm above 3,100. At the end of the day, and the dust settled, the Dow was down 5.5%, S&P down 6%, and the Nasdaq down a bit over 5.75%. And those are just the daily figures. The Nasdaq officially entered bear market territory, down over 20% from recent highs. Meanwhile, the S&P saw its worst week since the March 2020 COVID sell-off. Dow was down almost 8% for the week. S&P down over 9%. And the Nasdaq was down 10%. Just to add some quick notables, tech and consumer discretion, those names bore the brunt of the damage. Apple, Amazon, Tesla, and other growth leaders, they posted steep weekly declines, reflecting both valuation compression and new tariff headwinds. Meanwhile, defensive sectors like utilities, staples, and healthcare, they did outperform, and in some cases, they finished the week flat or even up. Markets are clearly pricing in the real possibility of a global slowdown or even a mild recession, but not yet a financial crisis. There's been no major disruption and dislocation in credit markets. Treasury yields suggest flight to safety, but not a full-blown panic. That said, sentiment is deteriorating fast, adding to the stress. Conflicting messages from the White House. While President Trump floated the idea of future tariff negotiations, his aides contradicted that, calling the current structure non-negotiable. That type of messaging added to the chaos and uncertainty, and investors are reacting accordingly. We'll also be watching how the global central banks and U.S. policymakers respond. If we start to see coordinated easing efforts, markets may find a footing, but for now, the narrative is being driven almost entirely by trade and geopolitics, not fundamentals. For all I think it will matter, the schedule for the week is irrelevant, but here you go. We'll get small business optimism survey results. Sorry, easy for you to say. And if it's looking up, it'll be written off as before tariffs. And if it's negative, well, who could blame them? You'll get Fed meeting minutes from last month, and that could bring something about possible Fed moves at certain pain levels, but it's doubtful. Normally, the CPI and PPI Thursday and Friday would make a difference. Again, I don't think it will. We will get Fed heads, a lot of them. I'm not even going to name them this week, but unless they change the tune from Powell that spoke last week, then they're not going to come to the rescue here. Then they will be ignored. Also, from labor markets, you'll get jobless claims and continuing claims, and though it will be ignored, I do want you to pay attention. This one is the most high frequency number that we have. We'll close off the week with the University of Michigan sentiment and inflation expectations. If we get a report on that on Friday and we actually pay attention to that, then we know the market's found some footing. So we'll have to see. Last week was a stark reminder that markets do not need a traditional economic shock to sell off. Policy missteps, especially on the global stage, they can shake confidence just as easily. We now face a market that's been technically damaged, sentiment that's fragile, and macro uncertainty that shows no sign of lifting soon. That doesn't mean it's time to panic. It does mean we'll continue focusing on high quality positions, diversified risk, and steady hands throughout this volatility. I was asked this weekend if I was going to repeat the stale line to everyone. I want to remind you that we've been discussing this all the way back to late last fall. Remember that risk audit and the idea that stocks can go down? Well, we said it then, and I'll say it now. We found out that they can go down. Let me know if you'd like to review allocations, reduce exposure in vulnerable areas, or consider more defensive positioning. We have prepared for this, and we're going to stay that way. In regard to the short term, I'll tell you, I read a great quote this weekend. Comfort is the enemy of greatness. If you're not scared, you're not building anything. I will remind you what I've said week in and week out. Changes bring opportunity. Excuse me. We need to determine what opportunities are for each of you, and let's talk about it. I'll try to keep you informed with these videos, so please check back on them. For now, today does not look like it's going to start well, but let's see how things go. Stick to the plan, and if we need to discuss that plan, let's talk. Have a great day.